Welcome back. Markets have been on a tear this year. The Dow and the S&P 500 hitting multiple record highs. The Nasdaq up better than 21%, outperforming both indices due to the AI rally. But over the past week, investors have begun to question those AI valuations and whether they've run too far. Big short investor Michael Burry betting against the AI boom, accusing technology giants of, quote, inflating profits. Joining me now is the Chief Investment Officer of Nuveen, Saira Malik, is here this morning. Sarah, great to see you.
Good to see you.
Thank you so much for being here. And you've got $1.3 trillion in assets under management there at Nuveen. How are you invested?
Well, what we're seeing is it's time to get more diversified. So not only are we bullish on technology stocks, but we're looking at other areas like real estate, where you're seeing 5 quarters of positive returns, private equity, which should strengthen as M&A picks up and interest rates decline, and then AI derivative areas like infrastructure, where we're building more in America, bringing more manufacturing back home, and building in order for these AI data centers.
I mean, you've got to question how much money has gone into AI and data centers, right? I mean, I know you've said the AI boom is alive and well, but when will we see a return on investment to what Jensen Huang said is going to be trillions of dollars in new money going into the build out of AI?
I think that's the main question that investors are asking themselves right now. So we're looking at a third year of the markets hitting new highs, and that's obviously very great for equity investors. But there are 3 things that investors are worried about. First is we're questioning what is the return on investment on AI spending. Second, of course, what is going to be the pace of rate cuts. And third, economic data and what's going on with the employment market. So the first one, this rally has been led by technology stocks, and we've seen billions of dollars spent on AI, and the return on that may have a bit of an air pocket. If you look at seasonality for tech stocks, November through January tends to be a seasonally weak period for that sector. So I wouldn't be surprised to see somewhat of a healthy correction in tech, but going into next year, I think we will start to see productivity and revenue gains from artificial intelligence.
Tell us about the infrastructure trade and where you're looking to invest.
Yeah, so infrastructure is a great sector because not only does it have the tailwinds of building more manufacturing in the U.S. for data centers, but also the upgrade of our grids, electrification of our economy, the shift to renewable energy. And the segments in infrastructure, like utilities and waste management, tend to be less cyclical than the typical economic sectors. They also have the benefit of inflation pass-throughs. So a lot of tailwinds for infrastructure, and the sector is not expensive.
What about private equity? Where are you finding opportunities there?
We think private equity will finally have a revival after lagging for a couple of years. First of all, M&A is picking up. Interest rates are declining. Whether we get a cut in December or not, our view is 50-50 chances, but we think that we will have about 3 cuts in the next 12 months. And the IPO markets are opening up. All of that positive for private equity.
Well, it's interesting because we've been, hearing so much about all this business that's been on the shelf because the government has been shut down. Do you expect that there will be a longer lasting impact of this government shutdown? I mean, 4th quarter numbers will certainly show a lack of business, right?
Well, the issue has been for the Fed, in terms of the rate cuts that everybody's expecting, they've been flying blind because we have not gotten a lot of economic data due to the shutdown. We're seeing this week a relief rally because we expected the government to reopen within the next matter of hours or days. But the Fed now needs to catch up. We don't really know what's been going on with inflation. The small amounts of employment data we've been getting have been telling us that the employment markets are weakening. Now, if employment markets were to significantly crack, that usually happens at the beginning of a recession. However, I don't think we're there yet. I think employment is flashing somewhat of a yellow light for the markets. But if you look at 3rd quarter earnings growth, coming in at over 10% year-over-year growth, I think the economy is still in good shape.
All right, but look at yields this morning, down 3 basis points on the 10-year. There is a split at the Federal Reserve right now on whether or not to cut rates in December. Governor Stephen Myron pushing for a bigger cut, 50 basis points. Then you've got others with a more cautious tone. What are you expecting in December? Consumer sentiment fell. ADP data shows companies shed about 11,000 jobs a week in late October. And of course, then we had that Challenger report the other day on jobs, which showed more than 153,000 job cuts in October, the highest for the month in 22 years. Will these be catalysts for the Federal Reserve in its December meeting?
I think right now, from what we know, the December rate cut is a coin toss. Now, as we catch up on some of this data, we start to see the backup payroll data. We see more inflation data. It could increase the chances. I think maybe we'll get a 25 basis point rate cut in December when all is said and done. But the important thing is, whether we get that cut in December or not, I see 3 more rate cuts next year. We will have a new Federal Reserve chair in place. I think we're going to be leaning dovish as a Fed. So we are going to get those rate cuts. So the market can count on those. I think what the worry will be is if the employment market cracks faster than investors expect, that could be an issue where the Fed could fall behind the curve. But we're not seeing that yet.
Well, it's a great point to make that once we go into 2026, we're expecting an easier Fed because you've got a new chairman, which will be President Trump's pick. What about fixed income here? How do you invest in fixed income in that backdrop?
I think the most attractive place in fixed income is where we've seen the biggest laggard, and that's municipal bonds. They have lagged the aggregate fixed income indexes year to date for a few reasons. Number one has been high interest rates, but also there's been a lot of supply in the muni bond market. But remember, municipal bonds are a necessity. They are, in a sense, an infrastructure play also, and they are now starting to catch up as we're seeing rate cuts, as supply is starting to subside. So I think muni bonds is going to be a key attractive area of fixed income in 2026.
And in equities, you mentioned derivatives of the AI trade. That's a big sector there. You want to still be dominated by tech when you're talking specifically equities?
You want to be balanced. And one thing with the AI trade is people talk about, are the Mag 7 stocks in a bubble? Now, if you go back in history to the late 90s, which is the comparison that a lot of people look at, the NASDAQ 100 is trading at still about a 40% plus discount right now to where it was in the late 90s. So I don't think that the NASDAQ is necessary in bubble territory, but what we need to watch is how is that spreading across industries? There's so many repercussions of other industries that are investing or benefiting from AI.
Yeah.
Are we overinvesting there is the key to what we're watching. We still think that the AI boom is alive and well, but we're balancing that also with companies that pay strong dividends. So for those who are worried, there's lower volatility segments like dividend growers, which are strong fundamental companies with strong cash flow that pay more and more dividends over time. That's an area where you can balance the tech trade, but I wouldn't bet against the U.S. and I would not bet against technology stocks.
And you got to put energy in that category, given the immense demand for oil and gas, certainly natural gas, in this AI boom. Sarah, it's great to get your take on all of it. Thanks so much.
Good to see you.
All right, Saira Malik from Nuveen.